I don't really like the usual way of trading support and resistance, but I do really like this liquidity trading strategy. So in this video, we're going to talk about support and resistance, what I don't like about it, what I do love about it, how I trade it, and how you can use it to win. So with that said, let's get into it. So the common way to trade support and resistance is much like what you see on the screen. For a support, it's basically an invisible line that price retests multiple times. The idea is to buy from that level, expecting the market to go higher. The same happens on the sell side. You would sell a resistance level, expecting the market to go lower. Now, the other way to trade them is with break and retests, which is what we see taking place here. In this instance, we have a resistance which has reacted multiple times, and then the market broke through with this push to the upside. Buying the retest would be the move that most people would make, which essentially means you would buy once the resistance was retested again as a support, and then you would anticipate the market to move higher. Okay, the same goes as well on the sell side. If a support floor breaks, you would look to sell the retest as a new resistance. But there is one big problem with all of this, which means it's quite low probability that this stuff actually works. The one big problem with standard support and resistance trading is something that we call liquidity. So I'm going to run you through from start to finish as to how this works and why this makes support and resistance, in my opinion, not one of the best concepts to trade. But it does itself, when we add liquidity into the picture, provide opportunities for you to take some great trades and build a solid strategy. Kind of against the standard flow of support and resistance. So in this example, we're looking at a support. A support is a line that is drawn on a chart where multiple touches of the same price area have been created. So after the first two taps, this is 1, this is 2, the idea will then to be buy the market when it hits this level. So we will have buyers stepping in at these areas, looking to take this market back higher. So what we actually then end up with is a large collection of buys in and around this point. Now, standard education suggests if you buy a support floor, you put your stop loss underneath the low. So the area just beneath the support here will have lots of stop losses. Now let's think about what stop losses actually are for a moment. If you've bought a market and you've placed a stop loss, your stop loss is a sell order. You've placed a buy order here or here, and your stop loss is simply an order that will automatically sell your contracts back to the market for a loss if the market gets lower into here. So what we actually end up with in the form of stop losses here is basically a bunch of sell orders, because the buy orders have conflicting sell orders, which are stop losses, which will, of course, sell contracts to the market in the case that the market comes lower. This will limit the losses of the buyers, but it will essentially create a large pool of selling orders that haven't been tapped into yet. Alongside the sell orders, we will have sell stops. So remember when we looked at that break retest opportunity just before this? Another way that people trade is when the market breaks, they will expect the support to act as a resistance and the market to go the other way, like this, okay? So we have two lots of traders. We have buyers buying support from here, hoping for this move. They have sell orders in the form of stop losses beneath the level. And we have breakout traders who are looking for a break, retest, and continuation lower. They will have sell stops, which is an automatic order that will trigger you into a sell trade when a level has gone. So now we have lots of sell orders in the form of sell stops and lots of sell orders in the form of stop losses, basically creating a large pool of orders. Now these orders are referred to as liquidity. So down here we have a lot of liquidity. Now, markets move up and down based on the buying and the selling that's taking place inside of a market. We have lots of buyers in certain instances, and when buying is stronger than selling, markets go up. And we have lots of selling, and when selling is stronger than buying, the market goes down. But what actually happens when we reach into large areas of orders is basically large market participants have an opportunity to take the other side of the trade. If we have a massive collection of retail sell stops, sell orders here, creating liquidity, that means that a conflicting party, let's say an institutional trading firm, who wants to buy this market en masse, well, this is going to be their opportunity to do so when the market comes into here. because all of these sell orders will provide liquidity for buyers to come in. If we think about where we are right now, if you wanted to buy multi-million-dollar contracts, you wanted to put a massive order on for, let's just say random example, $100 million, it's going to be hard to do that without moving the market. Because as we just said, when there's more buying than selling, markets go up. So if you tried to buy massive sums of money, you're going to get a staggered entry, just like what I've drawn on the chart. Your buy is not going to be filled at this level. Some will be filled here, and more here, and more here, which is going to leave you with a very bad average price. Now, if you consider all of the sell liquidity that's sitting in here, if you could just allow the market to run into that level, well, now you have so much selling taking place that you could get the majority of your large order on pretty much immediately, because you would have lots of sellers offering their units to you at one given level. So if you wanted to buy a significant amount, the best place to do it is here, where there's a mass amount of selling taking place at exactly the same time. If we think about these buyers, we have some buying here, some here, some here, some here, some here, some here. It's all kind of staggered. But if the market drives through to here, every single stop loss of all of these traders and every single sell stop of the breakout traders looking to go the other way, it's all going to be hit in one go, which provides that mass liquidity that you could use on the conflicting side of your trade to get yourself into a large position. So what we rarely see, or what we see less often, is just clean moves from support leading into new price levels. We also rarely see clean break retest trades. Most of the time, the market is not going to act in either of these ways. What usually will happen from an area of support or resistance is something like this, which is you get into a trade, it feels like a great position, you think everything is going to work just fine for you, and then the next thing you know, the market stops you out and then moves very quickly in the direction that you wanted to go. And now you're sitting here scratching your head thinking, how on earth did this happen? I prepped a trade, it was all perfect, and then the market seems to have stopped me out on purpose before running to my target. Well, this I've just explained to you. It's because of the liquidity. Your stop loss is where major orders are being allocated in the opposite direction to the way that you're now expecting it to go, and in the same direction as your initial position was hoping to move in. So this is why, if you trade support and resistance, you'll have noticed your trades getting stopped out before moving perfectly towards your targets. It's frustrating, but understanding this liquidity and understanding why it happens, as I'm explaining to you now, is very, very valuable. Because what if we were able to actually join this move around here after the liquidation had taken place? Well, the good news is we can do that. We can basically piggyback the moves of institutional participants, avoid the trap and avoid getting stopped out, and join a little bit later just as the big move is beginning. Now we're going to go to a real chart and I'll show you how we put this into action in reality. So for this example, we're going to look at the sell side of a market. We're looking at it the other way round to the example we just showed, but everything is the same. So what we can see here, looking at this market at first glance, is a resistance, okay? We have 1, 2, 3, 4, 5 drives into the same price level. So this creates a resistance which most traders will see as an opportunity to sell. What we have here is lots of people stepping in and selling here, selling here, selling here, and here. This resistance, therefore, creates lots of liquidity above, meaning sellers that have sold into the market here have stop losses in this area. These stop losses are buy orders. When you short sell a market, you are selling a contract with a promise or the obligation to buy it back later. That essentially means that if the market gets into this range, there's going to be a lot of buy orders waiting for someone to take the other side if they want to. The other way of trading this, as we've covered, is going to be through break retests. So as well as the buy orders in the form of stop losses, we have buy stops, which are orders that will automatically trigger a buy if the market pushes through this level. So now we have buy stop liquidity and we have buy order liquidity. So essentially what we have in here is a whole lot of liquidity, okay? Now, if we understand there's liquidity above, we therefore understand the likely scenario is going to be the market will reach through into this level. Ideally, no institutional selling essentially will take place under that level, which therefore will naturally drive the market higher because there isn't significant selling pressure. And when we reach this area, we could see institutional money coming in the form of sell orders, taking the other side of all of the buy stops and buy orders in the form of stop losses that are triggered at the same time. So if we were looking for a significant drive down, for simplicity's sake, we'll target this low. If we were looking for a drive down from here, the wise move would be not to sell from this resistance, but instead to wait for this resistance to break and then look for an opportunity to sell from up there. Now there's two ways that we can do this. I'm going to show you both in the format of this trade. So if we let the market step forward here, we see the liquidation takes place. Everyone who sold in this price region here has been stopped out of this trade for a loss. The majority of stop losses will be up here. They're now out, they've lost. The other thing is the buy stop traders who are now stepping into the market are very soon going to lose as well, because we see significant selling inflow, which actually brings the market back down. Now, the first way that you can benefit from this style of trade is with a more aggressive entry. And a more aggressive entry will actually zoom in on the price action in and around this area to look for a short opportunity to take the market lower all the way from up here. So this would be your first way to get into a trade. Now this example, we're looking at the 4-hour time frame. We're going to scale down to the 1 hour and 30 minute for this execution, but this works across all time frames. Okay. Now, if we step down to the 1 hour time frame and take a look at the structure that's been created up in this high, and let's remove some of this to keep it neat. We now understand if there is a likely area for reversal, it's going to be in this area that we've just discussed, right? So let's take a look at the market structure, which we do this by looking at highs and lows. We have a higher low, and a higher high. This is only a very slight higher high, but this high is pushed higher than the previous one, which tells us that this movement just here is the high of the move. And then the significant structural low of the move would be this level here. So what we now have from a market structure perspective is a sweep of the high and then a push, break and close underneath the previous low, which is this low just here. Now this break of structure indicates to us that this market is now ready to move from highs into lows and indicates the start of a new trend. What we would then look to do is identify a supply zone. For me, that's the last candle before the impulse. So the supply zone I would work with here would be this gray candle. I'm going to pull it across a little bit just to cover the wick. Basically, we're doing that just for safety's purposes. The supply zone I would look at would be this area here, okay? But I do want to cover the wick because any stop loss I place here would go above that wick just to be safe. Now, with this break of structure having taken place, the market's pulled back to this area of supply. So we would then look to sell at that supply with a stop loss above the high, and then our target could go down into wherever our natural initial target was. In this instance, that's going to be down at this low, 1.9115, which is just this next demand zone that I'm looking at for this example. So that is execution number one. That is the first way that you would look to get into one of these liquidity sweep trades. Notice how instead of selling resistance, we've actually waited for resistance to break and then found an opportunity inside of market structure, which simply refers to the high and low structure of price, right? We've looked for this entry model here and we've sold into that, expecting the market to now make its downturn, because we've seen with this large selling candle and the break in the structure that the sellers are indeed taking the opportunity here to sell in mass. So this is opportunity one. Now, if we allow this market to run forward, you'll see we get a large drive to the downside, which is very, very good. But we've only really come down towards the lows of the range. We've only come down to the point of which sellers were able to get to previously multiple times. So the sellers here managed to bring the market down towards around this point, and the sellers here did it as well with this drive down. So we're looking for a more significant move, which provides the second opportunity, which is the more high probability or the higher time frame, more conservative opportunity. Now, if we take a look back on the 4-hour time frame, which is where we initially found this trading opportunity, we'll leave opportunity one on for now, but we're going to then focus on the higher time frame structure as if we never had a position. Now, we can look at this in the same way from the structural perspective. We have a high, a higher low, a higher high. Now the market's broken and closed with these gray candles underneath the higher low. So what we can actually do at this point is look for a pullback to create a lower high and then sell into a lower low. The supply zone being the last candle before the impulse, well, that's for me going to be, here's the impulse, here's the last candle before the impulse. So we're going to use this as our supply zone for this higher time frame position. We would then place our selling order on this zone, a stop loss above the zone, and our target can go down into the initial target we were looking for the market to reach into. Now we would see the market pulling back to that level as a selling opportunity. And as you can see, if we'd sold into the market at this level, we would then get our slow run down towards the target, filling the position profitably. So now we have two opportunities that have resulted in a profitable outcome for selling at this level. The first is the larger reward, but it's also larger risk. We're joining just as we get the first indications that this could be a liquidation or a liquidity sweep. The second is more conservative. It's a lot safer. We've seen a break of the range now. We've seen confirmed validation that sellers are taking this market lower. So this one is higher probability. You're going to lose less trades by taking this one, but it's only returned around 50% of the total profit that the more aggressive position would have given you. So this one is higher risk, higher reward. This one is lower risk, but lower reward as well. Regardless though, both situations present to you, number one, the problem with support and resistance, and that's the fact that there's liquidity above these areas, or in the case of a buying opportunity, below these areas that is likely to be taken out. And number two, as well as showing you the problem with resistance and support, it shows you how we can take advantage of the weakness of everyone who's selling here to, number one, capture an aggressive high reward trade from here once we start to get that market reversal, or following on from that, take this more conservative approach once we see validation of shorts and once we see the lows of the range where the liquidity was created broken. We then get to sell here and take it down to the more significant target. So you'll notice, even though we did get some movement on the sell side in these movements down, we were pretty confined and we never managed to go and hit a lower target or a more significant price range. That only occurred after the liquidity had been taken. This happens because the significant selling coming from institutional participants is happening here, not here. So if you're the person selling here, you are likely going to create liquidity for the big players who sell here, and they will stop you out and then enjoy the profits that are made on the run down as you sit and lose and get angry because you got stopped out before the trade worked in your favor. But you don't need that to happen ever again, as long as you follow this liquidity trading strategy. So instead of selling from here, expecting the market to go down, or instead of buying from here, expecting a break retest to work out, wait to see if you get a break in the structure after liquidity has been swept. And if you do, you can look to sell from here. And if you want to play it even safer, wait for that market to break down past the lows of the liquidity range, and when the market pulls back, you can take a position like this one.